Welcome to TAX3701. My name is Roulon du Toit. I am one of the founders and the tax lecturer at CA Campus. CA Campus is proud to announce that we will be offering selected undergraduate subjects from 2017 on our online program. And this tutorial is designed to give you a bit of a taste of what we do in our program. So let's start. Now basically in this tutorial, the example that I'm going to be looking at with you guys is an example where you have to calculate the taxable income of a company. But what does this example ask you to do is to do two calculations. One, where you calculate the taxable income starting with the sales figure, and two, doing the taxable income calculation starting with the profit before tax figure. Either of these options can be asked in your exam. Students sometimes find it a little bit more challenging to do the one where you start with the profit before tax, because it takes into account certain accounting entries that have been passed, things that you have to reconcile. But what I'm going to attempt to show you guys here is to show you that it's very, very simple to do the two if you understand especially what you should be doing when you start with sales. Right, so if we look at the required in this question, the required in this question says you are required to calculate. Always pay attention to the verbs used. Are they asking you to calculate or discuss something? And you are required to calculate the taxable income for the year ended 31 December 2015 by A, starting your calculation with the sales figure. Right, so sales figure basically means we have to start over here with sales figure, and B, starting it with a profit before tax figure. Okay, and again, if I take you profit before tax, starting over here. All right, and then it tells you must include an explanation where amounts are not subject to tax. Now guys, 31 December 2015, if that is the year-end date, please remember it means the tax year ran from the 1st of January 2015 and it ran all the way to the 31st of December 2015. If you sometimes make mistakes when you have to apportion amounts, it might be helpful for you to draw up a timeline. Just to remember 1 Jan 2015 to 31 December 2015. This is quite important when you want to make sure and remember that transactions or amounts fall within your tax year. Okay, so let's move on and let's actually start looking at this question. Alright guys, so the first thing that you always need to remember when you are answering a question is that you must clearly indicate what question you are answering at the top of your page. In this case, we're answering question 1A. Very often when we mark, we find that students do not put down the headings and the question numbers, and it makes it very difficult for the examiner to know what they are looking at. Please make it very clear. You don't want to lose simple marks for presentation. Then we need to use a couple of headings for a calculation. Now when it is a calculation question, we typically have to use these headings for our columns. Description, calculation / explanation, we will have a column over here for capital gains tax calculations that we perform, and we'll have a rands column here, and this rands column over here is basically your taxable income amounts. Right, so P Limited is a company with a 31 December year end. P Limited is a registered VAT vendor and all amounts below exclude VAT. Now, it is very important to remember that when a person is a VAT vendor, like they indicate here, the VAT vendor might be able to claim input tax and will have to pay output tax. Now, why is this important when we're looking at an income tax question? Because there's a section that tells us in the Income Tax Act, it's called Section 23C. It's not very important for you to remember the section number right now, but Section 23C says that if you had an amount, so let's say for example I've purchased inventory at a cost of 114,000 rands including VAT. My input tax that I'll be able to claim on that is 114,000 times 14 over 114, so 14,000 rands. What section 23C tells us is now when we are doing our income tax, you cannot include that 14,000 rands VAT amount as part of your cost for your stationery or as part of your expense when you're paying, for example, a rent, for example, to a commercial rental. So, what does it mean? It means that if the total cost is 114,000 and the VAT on that was 14,000 rands, then what we need to use for income tax purposes is the 100,000 rands, and this is used for income tax. Now, why is that important for us? If they tell you that all amounts exclude VAT, it means that they've already they've done this calculation for you already. Right, so very, very, very important. If you cannot claim the input VAT, so let's for example say we spend 140,000 rands and we couldn't claim the input VAT. For example, we might be using it for exempt purposes if you remember from VAT. Then we can't claim that 14,000 rands over there. So then our total cost will not be 100,000 rands, it will be 114,000 rands. So that's basically why they always tell you in questions that the guy is a VAT vendor or he's not a VAT vendor, and whether the amounts include or exclude VAT. All right. So let's continue. So it tells you P Limited is not a small business corporation. What is also very important to remember about the small business corporations, if you have a small business corporation, there are special rules for manufacturing assets you can claim 100% in year 1, and for wear and tear you can claim 50% in year 1, 30% in year 2, and 20% in year 3, and you do not apportion these for less than a year. What does apportion mean? It means, for example, if you've used an amount for 8 out of 12 months, that over there is the apportionment. Right, so they are not a small business corporation, so it means that these rules which we just discussed over here, if they're not a small business corporation, do not apply to it. What will instead apply if you're not a small business corporation? When it is a manufacturing asset, you will get a Section 12C allowance, and in year 1 you can claim 40% if it's new. Year 2, 3, and 4 you can claim 20%. If it is a second-hand machine under Section 12C, in year 1, 2, 3, 4, and 5 you can then claim 20%. So you don't have the 40%. Alright, so let's continue through the question. So they tell us that they provided us with a statement of profit and loss and other comprehensive income for the year ended 31 December 2015. Right. So there's a sales amount in there, there's cost of sales, etc. We've got some notes over here, and let's go. Alright guys, so remember now, in the first question that we are doing, we have to start our calculation with sales. That was our instruction that we received. So sales of 12 million rands, and that is our first amount that we will include. So sales, 12 million rands. Our rands column over there. £12 million. Simple amount, Gross income, no problem. So, sales, we've included. Then we've got cost of sales. Now guys, remember how cost of sales is calculated for accounting purposes? It's basically opening stock plus purchases or manufacturing less closing stock. And that gives us our cost of sales. Now, when you're looking at income tax, opening stock is allowed as a deduction, purchase is allowed as a deduction, and closing stock must be added back. So what are we saying here? That income tax and cost of sales, or basically the income tax, the cost of sales amount for income tax and the cost of sales amount for accounting are mostly calculated in the same way. There are some differences, but they are mostly calculated in the same way. Now, if you look in this question over here, they just gave us the cost of sales. They don't give us any further information. So what will we have to assume? We'll have to assume that the cost of sales have been calculated correctly and that we can use it for income tax purposes as well. So that 4.5 million rands that has been calculated for income tax purposes. We have our cost of sales amount. And that's a deduction. Clearly indicates to your examiner that you know it's a deduction. I would recommend do not put a minus sign and say it is 4.5 million as such. Sometimes, especially if you have a lot of calculations, that little minus sign gets lost. So it might form, it might get a little bit lost when you've been writing things here. So brackets, much more clear. Strongly recommend you use brackets. Right, so that's the 12 million, that's the 4.5 million, both of those done. Gross profit is just a subtotal, there's nothing that we do with that. Then we have salaries. Salaries of 1.2 million rands has been allowed as a deduction, or has been deducted from accounting. So what do we do with salaries for tax purposes? This is where, I'm just putting it here in a different color, just as a note for yourself. You have to remember your notes and your content on general deduction formula. The general deduction formula basically tells you that if you are carrying on a trade, any expenditure and losses actually incurred during the year of assessment in the production of income not capital in nature and to the extent of trade. They tell you that if you incur an expense and you are carrying on a trade and it's actually incurred during the year of assessment in the production of income and it's not capital in nature, and then to the extent of trade means you have to apportion it if you use it partly for trade and partly not, then you may allow it as a deduction. So salaries, if you've got a business, we expect to pay salaries, the people working for us must earn an amount, so salaries will be allowed as a deduction in terms of the general deduction formula. So 1.2 million rands for salaries will be allowed as a deduction. Also, before I move on, please remember that the general deduction formula can easily be a discussion question in your exam. Okay, so that is the salaries amount also done. Now we have insurance, note number 1, 140,000 rands. So let's look at our notes. They tell us in our notes that on the 1st of June 2015, P Limited prepaid its insurance premiums for the next 12 months. The monthly premium is 20,000 rands. Okay, so let's quickly talk about what P Limited did here. So, on the 1st of June 2015, they prepaid the insurance for the next 12 months. So they basically prepaid it until the 31st of May 2016. But what is important that we remember now, our tax year runs from the 1st of January 2015 to the 31st of December 2015. So if we look at this prepaid portion over here, and I draw a line like this, from the 1st of June until the 31st of December is in our current tax year, and from the 1st of January 2016 onwards is in the next tax year. Now, the reason why we split that out is because there are different rules which are applicable to expenses incurred within the current tax year and expenses incurred in the next tax year, or as we call it, prepaid expenses. The expenses in the current tax year, that amount will be allowed as a deduction if it is allowed in terms of the general deduction formula. So it works the same way as we just looked at salaries. So the question that we have to ask ourselves is, if we incur an insurance expense, is that in the production of income? Can we say that it is an inevitable concomitant, that's the term that they use, of our business, of producing income? And we can comfortably say that yes, definitely it is. It is expected that companies pay insurance, and there's nothing out of the ordinary in this case. So let's talk about the prepaid expenses. So what I want you to see now, when we're looking at prepaid expenses, we've got these two periods here, current year, future year. So the current year, please always start by handing it on its own as a deduction or not, like we just discussed. So if I take you back to the information, we know now, let me actually express it like this, that there is 7 months in the current year and there are 5 months that have been prepaid. Okay, so that's 7 months. So what is the amount for the 7 months? Now, if you look at the question, they tell you that the monthly premium is 20,000 rands. So what I would like you guys to just make sure that you can see this. Is important to remember. If you look at the amount that has been deducted in our statement of comprehensive income, it's 140,000 rands, which is 20,000 times 7. Okay, so please don't think that the 140,000 rands there represents the 12 months period, because remember, we have the accrual basis in accounting. They do not have to give you this sentence that I gave you here about the monthly premium is 20,000 rands. You would have to be able to tell that if that is 140,000 rands in the statement of comprehensive income, it means it is 20,000 rands a month. That is very, very, very important. So let's deal with this current year insurance. So what I'm going to suggest we're going to do is I'm going to put down insurance over here. And let's talk about the current year. You can deduct this in terms of the general deduction formula also. 20,000 times 7. It would have also been appropriate to just write the amount because I did give it to you in the statement of comprehensive income. When in doubt though, always show your calculation. Right, and then we have our prepaid expense. Now, how does prepaid expenditure work? How does this prepaid expenditure rules work? Okay, I'm going to quickly explain to you guys over here. Prepaid. You can only deduct the prepaid amount if the prepaid expense is for 6 months or less, or if the total of all prepaid expenses more than 6 months. Does not exceed 100,000 rands. Right, so for example, if I show you this, let's say we have a couple of prepaid expenses. We've got prepaid expenses, we've got number 1, number 2, number 3, number 4, and number 5. I'm going to just put down random amounts here, just for an example. Current year, prepaid amount, and prepaid months. Okay, so how it looks is, I'm just putting down random amounts here. Let's say prepaid expense, number 1, I had 100,000 in the current year, that's the value. 50,000 for number 2, 80 for number 3, 200 for number 4, and number 5, let's say 60,000 rands. Okay, so that obviously gives us a total. Okay, of 490,000 rands. Now, first thing is, this current year amount here, it actually has nothing to do with determining if our prepaid expenses can be deducted. You will look at the general deduction formula for this. That will tell you if you can deduct it, or any of the other allowed deductions. So what I'm trying to show you is that this stop matches for us. Right, then we have the prepaid amount. Now, let's do the following for the prepaid amount. So let's say this is 200,000. This is 30,000. 50. 40. And let's just say 100. Okay, so 5 months, 8 months, 4 months, 7 months, and let's say 9 months. All right, so what I'm basically trying to show you here is that prepaid expense number 1 has been prepaid for 5 months, number 2 for 8 months, number 3 for 4 months, etc. And those are the amounts of the prepaid. Okay, so what I want you to see is, first thing that you do is, everything that is less 6 months or less, the 50,000 and the 200,000, those amounts you may deduct. So if I take it back to our prepaid rule, it tells you you can deduct it if it's for 6 months or less. Now what I want you to see is, look at the amount of this prepaid one. It's more than 100,000 rands. That does not matter. We do not care about the value of the amount. We only care about how many months have been prepaid. And as long as that is less than 6, you can deduct it. So that 200,000 you can deduct, and that 50,000 you can deduct. Now, the next part of the allowance tells you that you can deduct it if the total of all the prepaid expenses more than 6 months does not exceed 100,000 rands. So what does it mean for us? These ones that we've already deducted, the 5 months and the 4 months, those amounts we can now ignore. All right? And we are then left with, so let me take them out completely. So we are only left with the prepaid expenses which are for more than 6 months, as you can see over here. The total there is 30 plus 40 plus 100, so the total is 170,000 rands. Because that total over there is more than 100,000 rands, we cannot deduct any of the amounts. So what's important to see is we do not look at the 30,000 over there and say 30,000 is less than 100, I can deduct it. Or the 40 over there, we don't. We only look at the total amount, which is this 170,000 rands over here. That is what we look at. Right, so then you cannot deduct the 30, the 40, or the 100. Okay, so now that we've done a little bit of revision there, let's go back to our question, and I'll just remind you of what happened here. We said that there was insurance premiums which have been prepaid or paid for the next 12 months, and then when we looked at our calculation, we saw that it was for 7 months in the current year and 5 months prepaid. So what can we see here? Because it is for 5 months, it is less than 6 months, it means we may deduct it. So, prepaid expenditure over here, I'm going to make the comment over there, as prepaid for 6 months or less, prepaid amount may be deducted. And we saw it as 20,000 rands a month, 5 months, so we can deduct an additional 100,000 rands. Okay. So that is the insurance part. Just clean up a little bit here. That is the insurance part done. Next up is depreciation, note number 2, and they provide us with a couple of assets. Now the first thing we can do, we can start right away, is to look at that depreciation amount of 600,000 rands. And what do we know about depreciation? Depreciation is an accounting entry. It is not a tax entry. So depreciation, please make that comment for your marker. Depreciation is not a tax expense, or deduction is probably a better word. Why not? Well, you can say it's just an accounting entry, but the real reason is there's no expense or loss that has been actually incurred. Remember our general deduction formula. So no deduction. So indicate no deduction with a little dash. Okay, so let's look a little bit at the information they give us. So note 1. Machine A is a machine that is used in the process of manufacture. That is the most important term there. The process of manufacture. The machine was purchased new at a cost of 1.2 million rands on the 1st of August 2014, but it was only brought into use for the first time on the 12th of January 2015. So here's a very important principle to look out for in your exam. It was purchased in 2014, which was the prior year, but it was only brought into use in 2015, which is in the current year. You need to remember that you can only claim capital allowances from the moment it is brought into use. So 2015 was the first year of use for us for this machine. They didn't tell you that the machine is being depreciated over 10 years, which is its expected useful life. Please remember though, depreciation is again an accounting concept, so that does not matter to us. But then important guys, I want you to see here at the bottom, they also provide you with the useful life of the asset for income tax purposes. And I say here it is 6 years. From your studies this semester, you would have known that you used this to calculate our wear and tear, which we're going to be looking at in a little bit. Now, why are they giving us the manufacturing machinery over there? It doesn't mean for you in an exam that you now must go and calculate wear and tear on it. You can use that information as well in tax, but it is not applicable for you guys if the machine had a cost. So in other words, if you've paid for the machine, you will use section 12C and not the wear and tear section. Right, so guys, don't let them confuse you by including that information over there. So we'll use section 12C for machine A. Machine A had a cost of 1.2 million rands for us. Okay, so let's go and look at machine A. So machine A had a cost of 1.2 million rands for us. Now, remember when we spoke about the small business corporation earlier? We said that if you have a section 12C asset, year 1, you can claim a 40% allowance if it is new. If it is second hand, you can only claim 20% in each year. Now in this case, they tell you the machine was purchased new. So 1.2 million times 40%. Why 40% now? Because we brought it into use in the current year. So this is the first year of use for us. Right, so that gives us a deduction of 480,000 rands. Okay, so that's point 1 done. Then we have machine B. Machine B is a machine that is used in a process of manufacture. Great, so another process manufacturing machine. It was purchased second hand, that's important, on the 1st of February 2013. So the 1st of February 2013 is a prior year, it is the 2013 year. And it was bought into use in 2013 as well. So it was bought into use in 2013. It cost 650,000 rands and the machine is being depreciated over 6 years. Again guys, same thing happens here. Depreciation for us is irrelevant, that's accounting. And again, although it has a useful life over a year, we purchased and it has a cost, therefore we can calculate section 12C. Section 12C in this case is second hand, but it is also, not in any case, not the first year, but it is second hand. So, machine B, $650,000 times 20%. So 130,000. Right, then point 3. Machine C is a fingerprint scanner that restricts access to the company's factory to authorized workers only. So it's for biometrical access. The machine was purchased on the 1st of October 2014 and brought into use on the 1st of December 2014. So it was brought into use in a prior year as well. The machine has a cost of 240,000 rands and it has been depreciated over 2 years. Now, what's important here that you see, in the previous examples for machine A and machine B, they told us it is used in the process of manufacture. They do not tell us at year. So machine C is not a manufacturing machine. So what will we claim for that then? We will claim wear and tear. So we will claim it over 4 years. Right. So what you need to look at now, what you need to ask yourself is, if we look at our timeline, again, I'm going to take you back to our timeline over here, from the 1st of January to the 31st of December. How many months in this tax year did we use it? We purchased it at the end in December 2014, so before our new tax year. So we used it this entire tax year. That's important for you to see. We used it the entire tax year. The cost is 240,000 rands, being written off over 4 years. So machine C, 240,000 rands divided by 4, and we had it in this case the entire year. So that will be 60,000 rands for us. And in this case, it's the wear and tear section. If you are revising currently, it's section 11E. Machine A and machine B were both section 12C. Okay, and then we have 4. It says truck D is a truck that was purchased at a cost of 755,000 rands. It was brought into use on the 1st of January 2015, so on the first day of the tax year, and it's depreciated over 3 years. Same story again, guys. It's not a manufacturing asset, it's a truck. Trucks are written off over 5 years, and we had it the entire year. Right, 151,000 rands. Okay, so that's everything for the depreciation. Then we have profit on sale of an asset, note number 3, and they tell you it was 750,000 rand. So if we look at note number 3, it says on the 1st of August 2015, the company sold machine X for 950,000 rands. This was calculated using the carrying value of the machine on the 31st December, which was 200,000 rands. So they say selling price 950 less the carrying value. And guys, what is carrying value for accounting? It is cost less accumulated depreciation. Right, and that was 200,000 rands. So the profit that they've made was 750,000 rands. And that is what we saw in our statement of comprehensive income over there. But what do we know about profit on sale of an asset that has been calculated in this way? This is only for accounting. Tax does not work in the same way. Right, so they tell you the accountant has not taken into account depreciation for the current year. Machine X is a machine that is used in the process of manufacture. Alright, there we go again. What do we know about process of manufacture? Section 12C again. It was purchased and brought into use on the 1st of March 2012. So this is a prior year, and this is the 2012 year, and the machine had a cost of 800,000 rands. Okay guys, so now we're going to look at a little bit of recoupments. We're going to do a little bit of CDT. Right, so first thing that I would like you to address is the profit on the sale of the machine that they gave us there. And we just indicate that it is an accounting entry. So we're basically just telling our examiner we understand what they've done. It's an accounting entry, has nothing to do with tax. So let's do our proper calculation now. Right, so the sale of the machine. Okay guys, so how we do the sale of the machine is we do this, we always start with the following. And this is a process that I would recommend that you follow. It works as follows. You always start with the cost of the machine, which they gave us in this case as being 800,000 rands. Then from there you deduct all of the capital allowances that has been claimed. So in 2012, they don't tell us if it was old or new or second-hand or new if they don't assume that it was new. So 800,000 times 40%, 320,000. In 2013, it was 800,000 because it was year 2, so times 20%. So 160,000. 2014, same thing, 160,000. And then now in the current year, 2015, it's the same thing. But very important here, guys, lots of people don't see this. Please, this 160,000 rands, you need to go and include it in your taxable income calculation as well. So we'll deduct 160,000 rands for the current year. It's the same as what we've just did for machine A and machine B, for example. So now we've got the cost, there's all of the allowances that were claimed. That gives us what is called the tax value. So where accountants use carrying value, we use tax value, which is null. Okay, so now we have the selling price. And this is where we have to calculate the recoupment. Now, I'm not going to go into all the detail on how to calculate all recoupments, but what you need to understand about a recoupment, there's one golden rule for recoupments, and that is it can never be more, so it can never exceed the past allowances. Now guys, if you look here, these are the allowances that were calculated. In this case, it's 800,000 rands. So what you need to understand is that any recoupment that you calculate can never be more than 800,000 rands. It can be less, but it can't be more. Now, if you look at the selling price of this machine, just to show what's going to happen here, the selling price was 950,000 rands. If we now put in the selling price here and say it's 950,000 rands, when we calculate the recoupment, I'm keeping it in a different color, sorry guys, for now, because it's just temporary. If we calculate the recoupment, we'll say 950 minus 0, and that is 950,000 rands. So what's the issue we've got here? Our recoupment can't be more than 800,000 rands, but now we've calculated it as 950,000 rands. So you can either state it is limited to 800,000 rands. You can do that if you'd like. However, my recommendation to you would be to always just do the following. It's the simplest method, it is effective, and it will help with your understanding. And that is to say, the selling price that you use over here is the lower of the original cost, 800,000, or the actual selling price, which is, sorry, how much was it again? 950,000. 950,000. So you use the lower of the two, which is 800,000. 800,000 minus 0 gives us a recoupment of 800,000 rands, and that is what our past allowances were. It's not more than that. That's the one way of doing it, guys. If you want to save yourself a few seconds, you can replace this whole discussion over here. You can replace that little comment there by just stating the following. You can just say the selling price limited to original cost. Limited to original cost does not mean you must use the original cost. It says you must use the actual selling price, but it can't be more than the original cost, which is exactly what we do when we say the lower of the two. So when you're looking at solutions and you see them using this phrase, they're actually saying use the lower of selling price or original cost. Right, so 800,000. This recoupment over here of 800,000 rands goes into our taxable income. It's a gross income amount. Right, now, whenever you sell an asset, you must calculate capital gains tax. Now, as you know from your studies so far, capital gains tax is a whole big section on its own. You can, however, answer the majority of the capital gains tax questions if the asset is after 1 October 2001 by just doing the following that I'm going to show you guys now. Okay, and that is just to say capital gain. It's the proceeds amount. Proceeds is the selling price, always the full selling price, 950, minus the total recoupment amount, 800,000. Base cost is calculated as the original cost of the asset. Just to show you, original cost is that 800,000 rands over there. Less allowances. The total allowance in this case, again, is the sum of everything here, which in this case was 800,000 rands. It can also obviously be lower in exams, and sometimes it is. Right. So that total over there is 800,000. And then you say plus other costs after 1 October 01. And this will be all the other costs of selling and improving the asset that has not been included so far in the cost. In this case, there's nothing. Right, so our base cost is 800,000 minus 800,000 plus 0. So, and our base cost is 0 in this case. Right, our base cost is 0. So our capital gain is 150,000 minus 0, so 150,000 rands. Now you'll remember, if I just take you back up to the top of our page, we have a CDT column over here. So that 150,000 rands goes into that CDT column that we have. Alright, so that is the profit on the sale of the asset. Done. And then note number 4 is an impairment. So already you should see impairment is not a tax concept that we have. So I'm going to just go back to our solution. Let's just put it down. Impairment. I was going to say it's an accounting entry. Right, so no deduction. So let's see what it then says. It says the impairment relates to a design that the company purchased in 2014. So they bought a design for R1 million. The company does not amortize intangible assets. The recoverable value of the design was 800,000 rands at the 31st of December, and the accountant has determined that there is an impairment of 200,000 rands. Alright, so guys, that is a design. So what do we know about designs? We have capital allowances for our designs. And if you purchase a design, the capital allowance is the cost times 10%. For a patent, it is 5%. And if you purchase a trademark, you don't get any allowance. Right, so 100,000 rands. Then if I take it back, it then tells you, let's just first see. So that's the impairment done. Right, then it takes us back and it tells us the accountant has indicated that there was a net capital loss of 50,000 in 2014, which is the prior year. Alright guys, so we've basically come to the end of our question. You need to remember that you must do capital gains tax in the end. So what we do now is we add up everything in our CDT column, which is in this case 150,000 rands. Right, this is called, if it's a company, the aggregate capital gain. If you're looking at an individual, the aggregate capital gain is only calculated after deducting an annual exclusion, which is not applicable for tax 3701. Then we have any capital losses, which has been brought forward, and they told us that's the amount we just looked at in the question, 50,000. That gives us a net capital gain of 100,000 rands. Our inclusion rate for companies is 66.6%. Guys, pay close attention to that. It is not 67%. It is not times 2 over 3. It is not 66.666 or 666 or 66.67 or anything weird like that. It is exactly 66.6%. People sometimes take shortcuts by saying times 2 over 3. Wrong. So 66,600. That amount goes into our taxable income calculation. And then if I add up everything here, that gives us a taxable income. Remember, the question specifically asked you to calculate taxable income. So show your examiner what your taxable income is. 5,845,600. Alright guys, so that is part A of the question. We are now going to look at part B, and you'll see part B is a lot more simple because we're going to rely on a little bit of the information from part A. Okay guys, so let's start again with our question by drawing up or setting up our question area. So we are now looking at question 1B. The headings again, description, calculation / explanation, capital gains tax, and rands. Now what you guys will see when we go through this specific question is that we're going to go a little bit faster to save you some time as well. But if you understand what we did in part A, part B is very, very simple. Now, obviously in an exam situation, if you get asked to do it according to what part B says, you don't have the time to go and do part A as well. But you can quickly run through those processes of what you would have done in part A. So let me explain to you as follows. The most important thing that you need to see when we are starting with profit before tax is that the accountant has already done a lot of things to calculate that 6.1 million rands there. The accountant has added sales, deducted cost of sales, deducted salaries, deducted insurance, depreciation, added 750 for profit on sale of an asset, and deducted an impairment. But when we did the question just now, we did some of the things we did the same and some of the things we did a little bit differently. So for example, let's look at sales. In part A, what did we say we are going to do with sales? We said we are going to add it. What did the accountant do? The accountant added it. What did we say about cost of sales? We're going to deduct it. What did the accountant do? The accountant also deducted it. So as you can see, certain things we've done the same and certain things we have not. So what we are going to do is we're going to go through this line by line and we're going to ask, what did the accountant do and what should we do for tax? And if those things agree, we will note that there's no need to make any adjustment, but it's when they disagree when we have a little bit of an issue. Right, and we'll fix it then. So, guys, let's take a look at it. So the most important thing that you see is that we are going to be starting with our profit before tax. So our profit before tax amount was 6,110,000. So now we go through it line by line. Let's start with sales. So sales, the accountant has added sales. And if we see what we did in part A, we said we also would have added it. So the accountant has done it correctly according to us. So we'll say sales, there is no adjustment. So sales done. Then we have cost of sales. The accountant has deducted it, and if we look at what we said we should do, we would also deduct it. So cost of sales is also a situation where there is no adjustment required in this question. Done. Then we have salaries. The accountant has deducted salaries, and if we look at what we did in part A, we said we also would deduct it. So salaries is another one where there is no adjustment required. So we're basically just saying we're happy with what the accountant has done. Then we have insurance. Now remember what happened in insurance. Insurance is where they prepaid it for 12 months. Now, if you look at insurance, the accountant has deducted 140,000 rands. What did we do for the insurance prepaid? So if you remember, we had the discussion where we had the current year and the prior year. The current year, we deducted 140,000 rands. The accountant has done the same. Right? But what did we also do? We had a prepaid amount where we deducted 100,000 rands. The accountant has not done that. So let's fix the situation. So we'll say insurance, current year, that's the 140,000 rands. No adjustment is required. The prepaid portion, I'll just remind you, 20,000 rands per month. We only prepaid for 5 months because it's not more than 6 months, we could deduct it. So prepaid, you'll write the whole description out again. Obviously, if you had been answering an exam, but for our purposes, I'm just going to show you that we also deduct it. Okay, then we're done with insurance. Then we have depreciation of 600,000 rands, which the accountant has deducted. Now, if we go and look at what we said about depreciation, we said depreciation is not a tax expense, so there was no deduction allowed for it. So how are we going to fix it if this guy has now, this guy or this girl, lady, has deducted the depreciation? We will add it back, because we say the accountant has deducted it and we should not deduct it. So to eliminate it, we will add the 600,000 rands back. Then what you'll remember is that we had a whole bunch of assets which we claimed things on. We had machine A, B, C, and then truck D. And you'll remember that the accountant has not taken that into account because it's tax expenses. Those same ones, we will now still get our same deductions for. So 480, 130, 60, and 151. Okay, so we have machine A, machine B, machine C, and truck D. Machine A was 480,000 rands, that was section 12C. Machine B was also section 12C, but it was 130,000 rands. Machine C was the wear and tear, the fingerprint scanner. And truck D was also the wear and tear of 151,000 rands. Right, so that's the depreciation. Then we have the profit of 750,000 rands when we sold the asset. So what did we do for accounting of the profit? The first thing that we did is we stated that there's an accounting entry, so we couldn't claim it, we couldn't add it. So that's 750, the accountant has added, and we say he shouldn't have. So profit on sale of an asset is if he's added 750,000 rands and he shouldn't have, how will we get rid of it? By deducting it. Then, what did we do for tax purposes? We went through this big exercise where we calculated recoupments and capital gains and so on. That exact same calculation you would also perform now, because this is exactly the same as in situation 1. So just to show you what we did, we had 160,000 rands as a wear and tear deduction for the current year expense. We had 800,000 rands as a recoupment and a capital gain of 150. I'm not going to re-perform the calculation, but let's include it just the amounts, because understand again, it will be exactly the same calculation. So I'm just going to change color just to make it a little bit more visual. So we had sale of asset. We had our section 12C deduction for the current year, which was 160,000 rands. We calculated a recoupment. We'll do the exact same calculation. We calculate the recoupment of 800,000 rands. And we calculated a capital gain on this of 150,000 rands. And that goes into our CGT column. Right, so although I haven't shown the calculation, please understand that it is exactly the same calculation that we performed in part A. That is basically our profit on sale of the asset. So we have the impairment left. What happened to the impairment? The accountant deducted 200,000 rands. And what do we know the accountant should have done? We said accounting entry. There's no deduction for tax for that 200,000 rands impairment. So that impairment that was deducted, how are we going to fix it? We will add it back. Right, then we had a design of 1,000,000 rands and we got an allowance there of 10%, so 100,000 rands. The accountant, if we take it back, has not taken this into account. So that design must still be allowed as a deduction. So it's the exact same calculation, 1,000,000 times 10%, which gives us 100,000 rands capital allowance. Right, so then we got to the end of our question. What else did we do in part A? We did our capital gain calculation and then we had our taxable income. So what you'll see, what will happen now is we'll do the same. You will add up everything in your CGT column. Again, guys, because this is a company, that 150,000 rands is called our aggregate capital gain. From that, we deduct any capital losses which has been brought forward, which is the 50,000 rands they tell us in the question. There's then 100,000 rands, which is called our net capital gain. These terms are important, guys. They can ask you in an exam, they can tell you the net capital gain is 100,000 rands, for example, and you would have to know what to do with it. Then we have our inclusion rate. And again, our inclusion rate is 66.6%, giving us a taxable capital gain of 66,600, which goes into our rands column, and everything added up again gives us our taxable income, and it works out to 5,845,600, which is the same as the taxable income in part A. And that brings us to the end of this tutorial. So thank you very much for watching. CA Campus is proud to announce that we will be offering selected undergraduate subjects from 2017. This course will be fully online and will offer full support. Students are encouraged to consult with the lectures via telephone, email, or Skype. Please visit our website at www.cacampus.ca.za or email us at info@cacampus.ca.za if you'd like to find out more about our upcoming programs and if you'd like to see more samples like this one. We look forward to seeing you on our program.